Hello everyone, Chris Kelly here on behalf of all of us at Kelly Marketing Group. As always, I say happy Monday and hope you're all doing well. Hey, it's Monday, so I wanted to talk a little bit about the real estate market. I've pulled up this week's data and I have last week's data just for comparative purposes. But, as I've been looking at the last weeks now, because I think we're 10 weeks into actually doing reviewing data and starting to really track it this way. What it feels like is we're in late January, early February. So, cyclically when, the market during the holiday season, and as I always call it, the holiday hangover happens through the winter months, you physically get less listing inventory, less transactions, and there's usually less buyers in the market. So that's exactly what is happening numerically here, only it's being induced by a health pandemic and not the normal cycles of the market. I've had a couple of different podcasts that I have sent out. I think one of them last week where Brian Buffini interviewed Dr. Lawrence Yun, who is the National Association of Realtors chief economist, has been for years, sharp guy. Really no nonsense, just data, no spin. And both of those interviews, these gentlemen had talked about the market shifting. In other words, what normally would be a quote unquote spring market, happens in the summer or even in the fall. So this pause is exactly that. It becomes a pause. So does that mean that our normal spring market happens in the summer or even in early fall, depending on, how things actually come back, whether there's, any kind of second round of health breakouts, et cetera. So that remains to be seen, but it's clear to me that this is a pause. The numbers are coming up, so it feels like going into February where you get slightly more activity than January, but you don't really start cranking until May. And you look at May of last year versus April of last year, and so we've actually gotten a little bit further away, and that's because as the spring happens, more activity happens. So, when the numbers show, 48% off this week versus this week last year, it makes perfect sense based on what I'm talking about. So, one thing that's interesting is definitely the rate of inventory has come down more than the rate of the number of buyers active in the market has come down. So, 100 buyers that might, if it used to be 200 buyers, now it's 100 buyers. And if it used to be 200 properties, now it's 75 properties. So like I said, the amount of inventory has shrunk faster than the amount of buyers have shrunk in the market. And that's bodes quite well for a seller, to be honest. And that really has everything to do with why the average or median sales price is still higher than it was last year. And the days on the market remain the same or lower than they were this time last year. So the data has continued to play out as long as it's interpreted the way that it should be. So as always, I'm here to talk with you about it. I'm here to talk with you about your specific circumstances. Definitely there are different types of inventory and property in the market that are affected differently by what's going on. So if you're interested in talking more about this with me or any of us at Kelly Marketing Group, just let me know. You can ping me here on Facebook. If you see this on an email, you can get back to me at any of the many ways that I communicate. So anyway, again, I hope you're staying well, and I'll look forward to talking with you again soon.